Most people believe money is simple. You earn it, you spend it, you save what you can, but what if that entire belief is a carefully constructed illusion? What if the money you work for, the money you chase, the money you depend on, isn't actually yours in the way you think and hasn't been for decades? There are hidden financial mechanisms moving underneath your everyday transactions. They operate quietly, predictably, and without your permission. Tonight, we're pulling the curtain back on a system designed not by accident, not by mistake, but by intention. A system engineered to control your financial reality long before you ever entered it.
Trip. Let's start at the beginning, long before debit cards, credit scores, and national debts in the trillions. The story starts in 1668, when Sweden created the world's first central bank. It wasn't meant to manipulate economies. It was supposed to stabilize them. But something happened. Something subtle. Something dangerous. Governments realized that controlling currency didn't just stabilize a nation, it controlled the nation. Fast forward to 1694, when the Bank of England introduced a revolutionary idea. Governments could borrow money. Not just from taxpayers, but from the future. Debt was becoming a product. A profitable one. But this wasn't the final stage of the mechanism. This was only the seed. As empires grew, bankers noticed a pattern. The more people relied on a centralized money source, the easier it became to steer an entire economy without the public noticing. It's here, in this centuries-old experiment, that the foundations of your modern financial reality were quietly set.
Move to the early 1900s. The world was industrializing. New factories, new cities, new workers. And with economic expansion came instability. Banks collapsed often, panic spread easily. Something had to be done, or so people believed. In 1913, the United States created its own central bank, the Federal Reserve. A mysterious institution with unusual powers. It could create money, it could destroy money. And it could decide the cost of money, but here's the twist nobody saw coming. This wasn't a government agency. It was a network of private banks playing the role of a public institution. And once more, the mechanism evolved. From that moment, the modern financial system began operating on a simple but powerful principle. Control the money, and you control the behavior of the people who need it. This wasn't about cash. It was about influence on nations, elections, wars, inflation, and your daily life. For thousands of years, money was backed by something real, gold. But in 1971, everything changed. President Richard Nixon appeared on live TV and casually ended the gold standard, the last tie between paper money and real value. Overnight, the dollar became something new, a belief system. A promise backed by nothing but trust. The mechanism was now complete. Money no longer had intrinsic value. It was numbers on a screen, created and erased by institutions you never voted for and cannot see. And governments discovered the ultimate trick. If money can be created infinitely, your wealth can be diluted infinitely. This is the silent mechanism controlling your financial reality. The ability to expand or contract the money supply at will, without your knowledge and without your consent. Inflation isn't an accident, it's engineered. Debt isn't a burden, it's the business model. And scarcity isn't natural. It's manufactured. Once money became limitless, debt became inevitable. Today, the U.S. is over $35 trillion in national debt. Global debt is over $300 trillion. And households worldwide carry record levels of personal debt. But here's the eerie part. The system requires you to stay in debt. Because without your loans, your mortgages, your credit card payments, the entire structure collapses. Your debt is someone else's guaranteed profit. Your interest payments keep the machine alive. Your dependency keeps the mechanism stable. This is why wages stay stagnant, prices increase faster than income, housing becomes unaffordable, savings lose value, retirement feels impossible. These aren't coincidences. They're predictable consequences of a system designed to thrive only if you struggle. Governments have tried to fix this system many times. Stimulus checks, rate cuts, rate hikes, bailouts, new regulations, emergency programs. Yet every solution solves nothing long-term. Why? Because every fix relies on the same broken assumption. You can stabilize an unstable system by feeding it more instability. Rate cuts create bubbles. Bailouts reward failure. Money printing causes inflation. Regulations get reversed. Crises repeat. The pattern is clear. Every fix becomes fuel for the next disaster. This is why the 2008 crash looked like the 1987 crash. And why both looked like the crashes before them. And why all of them resemble the early collapses of the 1800s. The mechanism isn't malfunctioning. It's doing exactly what it was built to do. Takeaway 1. Money is no longer a store of value, it's a tool of control. Understanding this changes how you earn, save, and invest. Takeaway 2. The system is not broken. It's functioning exactly as designed to keep you dependent on debt, institutions, and cycles you didn't choose. Takeaway 3. The future belongs to those who learn the system's rules, not those who blindly participate. Warning. We are entering an era where digital currencies, algorithmic control, and centralized financial surveillance can tighten these mechanisms even further. If you think money controls your life now, you haven't seen what's coming. Call to action. If you want to understand these hidden systems, not the surface-level explanations, but the truth behind how money shapes your reality, make sure you like this video, subscribe, and turn on notifications. Because the deeper we go, the clearer the picture becomes, and the harder it becomes for the system to control you.